Good day, friends. Today I'm going to talk about a very important parameter of options trading, the delta Greek. In the last video, I received questions like, what is the delta of an option strategy? Some people don't understand what delta value means. What is the purpose of delta and how it's used in calculations? And now I'm going to deal with it once and for all. Without understanding what delta is, our future tutorials simply won't work. Okay, what is delta? It's the main Greek, the first derivative of the Black-Scholes model, which represents the proportion of futures, and we think of futures as of the market risk, in an option. Okay, let me open up the options board. We see here the near-term Bitcoin series. On the right are put options, and here we can see the delta indicator. Accordingly, the more in the money the put option is, the closer the delta will be to 1. Here, at strike 30,500, the delta is -1. The put option's delta varies from 0 to -1. At the center strike, the delta is around 0.5. Meaning the probability that the option is expiring in the money is 50%. And with options deep out of the money, we see delta that tends to 0. For example, a put option at strike 25,500 has a delta of 0. Okay, let me switch to the monthly series. And you can see that the delta values have changed. The longer the time frame, the more time premium these options have, and the less variability in delta. For an option with strike 33, we see a delta of -0.95. At strike 24, the delta is 0.06. But the situation with call option is quite the opposite. The delta of a call option varies from 0 to 1. Therefore, within the money options, delta tends to 1, while with out of the money options, delta tends to 0. But how does this data look in option strategies? Let me give you a simple example. Let's create a vertical spread. I buy call options with strike 29 and sell a call option with strike 30, 1,000 contracts everywhere. So if we multiply the number of contracts, 1,000, by the delta, 0.37, we get 370. And multiply 1,000 by 0.24, we summarize these results and get the delta of our strategy. In the end, the delta is 127. You can see this data here. The market risk of our vertical spread is 127 futures. So put it another way, our position is equivalent to 127 futures with corresponding P&L, losses, and risks. If we just had 127 futures, the risk would be the same. Now let's look at this strategy. And here, by pointing the cursor at the right part of the strategy, we can see what happens to our position when the price changes. If the price goes down, the delta tends to 0. But if the price rises and the spread goes into the money, the delta increases. Delta has its own chart. And this is what it looks like for our strategy. Why does it look like this? Let me remind you, we bought 1,000 options with strike 29 and sold 1,000 options with strike 30. Accordingly, if strike 29 options go in the money, the delta maximum is a long of 1,000. If strike 30 goes in the money, at expiration time, the delta will be 0. That's because 1,000 minus 1,000 equals 0. Delta is the most important metric for evaluating any option strategies. But now let's move to the desktop terminal. Pay attention to this strategy. It consists of a ratio spread, where 1,000 call options with strike 30 are bought, and 2,000 options with strike 31 are sold. And more put options sold. When the price decreases, the maximum delta value can reach 1,000. When the price goes up, the maximum delta is -1,000. Here in this line above, you can see this data. At the current moment, right now, the delta is 160. It will become neutral and reach 0 at a price of 29,156. Simply put, delta in option strategy is the angle of the strategy. the delta of a purchased futures is always equal to 1. The delta of sold options is -1. For bought call option, the delta is positive, and for sold options, the delta is negative. For bought put options, the delta is negative, and for sold put options, the delta is positive. And here in this column, you can see the total delta value. 1,000 put options sold of strike 26 give a delta of 160. 1,000 bought call options of strike 30 give a delta of 180. 2,000 call options sold give a delta -180. So we end up with a delta of 160. And on the chart that's on the screen right now, you can see how the delta behaves as the price changes. Of course, in delta hedging, we have to sell enough delta to get a zero. For example, in this case, we have to sell 170 futures, or 150. The price just changed. In delta hedging, the delta goes to zero. Delta can be sold in options and futures. But as a rule, the instrument with more liquidity is chosen. So let's sell 170 futures for the sake of the demonstration. We end up with a delta of 0. Delta hedging changes the slope of the chart. Delta is a very important tool, but often it does not reveal all the risks, because it is not known how the delta will change. Someday I will elaborate on the gamma Greek that risk managers use when assessing the risk of option strategies. So be sure to pay attention to delta, especially before expiration. The number of options in the money will determine the number of futures you receive, and you can neutralize those futures by buying them or selling them. And once the futures are delivered, along with ones you already have, everything collapses to 0. This is especially important when you're using synthetic constructs, synthetic futures, synthetic options, and it is very important that the futures collapse to 0, so that there are no risks with further price changes. And that's all I wanted to tell you about delta at the moment. Please use delta for calculations and modeling of option strategies. Share your opinion in the comments and ask your questions there. Give this video a like so other traders could find it. Subscribe to the channel if you haven't already. More interesting videos will be coming soon. I wish you good luck and successful options trading.